Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we talking about? Well, for the methodology and action, there's not a whole lot new to report on the next 100 trade series, so let's hold off on that for a little while. And I do have a new mystery chart for you this week, which could be one of my next trades that'll be reported. And then we have an old reveal. As far as what's going on with the market, I think now would be a good time to kind of show where we are with the market timing, and just based on my phone beginning to ring again. My phone only rings when things get kind of ugly, and we'll talk about that. And maybe that's the beginning of the end, although you can't time on that. That'll make sense in just 1 minute. For the Mind and Trade series, if you've been watching these shows, I get in these series and it seems like it's impossible to finish them because something new comes along and there's something I want to add to it. But I do want to begin to wrap that up, and then we could certainly come back to it because there's so much more to flesh out here. But for this week, and if we don't get through it early next week, we'll wrap up this series. Housekeeping, I do take requests. It makes my job a lot easier. DaveLandry.com/contact if you need to reach me with some requests. As I say each week, I still do a live show every week on Thursdays, and that's a little bit more open-ended. So I'm able to fit a lot more things in. And also, you can come live with your questions. Send them to me ahead of time if you want, and that way I could maybe put together a slide or two for you. Also, if you want the slides from this presentation and all my other presentations that I've done here for StockCharts, you can go to DaveLandry.com/StockCharts. If you do want to join that live webinar, and hopefully we'll go live with these shows again soon, and I'll check with my producer after I get this recording done to see when we go on live again. But anyway, and I'll have an update for you on that. But if you do want to attend the shows live, my weekly webinars, Dave Landry's The Week of Charts, you can go to DaveLandry.com/webinar and register. Register once, and you should be good for all of these shows. There's my Twitter handle. Each week I say I'm going to change that to something that's a little bit better, but that's it right there. All right, let's talk about the mystery charts and the methodology in action. This is a mystery chart from last week. Let's go ahead and do a reveal. And it is EQX, which is a gold stock. There are the parameters: entry of 385, protector stop of 330, IPT of 440. And this is what it looks like on the charts. We had a nice thrust higher off of multi-year lows, followed by a pullback. Entry here, stop down here, additional profit target up here. By the way, with these gold stocks, they're not going to be as perfect of a pattern as I normally like. And that's because commodity-related stocks can be a little bit choppy. So I do give them a little bit of a benefit of the doubt. But anyway, let's see what happened. Nothing. It just began to implode. So no capital was put into harm's way. As I've said ad nauseum, 6 months from now, I'll get a call from somebody and they're going to be in this EQX and it'll be like 25 cents or something. And it's like, geez, it never triggered. And sometimes I'll go back and forth with people like, I didn't recommend that. And they're like, yeah, you did 6 months ago. And I'm like, really? I'll go back and look and see that it never ever triggered. So make sure you're definitely waiting for entries. If we're in a rip-roaring bull market, he tried to say, maybe you could front-run these setups a little bit, but right now is not that time to do that type of aggressive trading. All right, new mystery chart. This is a bow tie, also a first thrust. There are the parameters there. It's pretty volatile, as you can see on the chart. So the stop is only 1 point, but based on a low price stock, percentage-wise, that's a pretty big stop. But that's okay. We have a similar IPT. Nice thrust from the lows. I believe this one was also a bow tie, and I'll show you the bow ties in 1 second for those who aren't familiar with the pattern. Nice little pullback in here. Entry here, stop down here, IPT up here. So again, make sure you wait for an entry on that one. And the bottom line is, with all these trades that aren't triggering and nothing's happening, that's all part of the methodology. And that's why I stopped the series I was working on and talked a little bit about know your nuances and know what to expect. And I covered a lot of that stuff also in my week of charts on Thursday nights. Anyway, getting back to the market and market timing and my phone ringing. Last summer, while the market was making new highs, I decided now would be a good time to get ahead of the market timing. Everybody calls me after the bomb blows up. And that would be now, obviously. And it's kind of a darned if I do and darned if I don't. If I explain to them that the market could go down as much as 50% or more, and it might take you 25 years to get your money back. Then, of course, they're going to get out, and what's going to happen tomorrow? The market is going to reverse. And if they don't get out, then the market's going to continue to drop. And this is why I did this segment while the market was making new highs. Now, I'll never be shot on Friday, but I really would wish that these people would listen to me and be willing to take a little defensive action. And I'll flesh that out in just 1 second. When I was putting these slides together, I went back to the presentation that I did last summer, and I found a couple of slides in there that I thought were pretty cool. And this is one of those last-minute type of ads that I put in last time, and I thought it was pretty interesting. I'd forgotten about it. Your life will be no better than the plans you make and the action you take. You're the architect and builder of your own life, fortune, and destiny. And that's Alfred A. Montapert. Now, this is interesting because I just got a phone call from someone, friend of a friend type of deal, and she was really concerned about the markets. And then when I started talking about the markets, she's like, I just don't, it's something I don't want to mess with. I don't want to take the time to learn. And I explained to her that I could probably tell her what she needs to know, not from a trading perspective, but from a market timing perspective. If the market goes down 10%, start to rethink your investments basis the S&P 500. And this is another one of those darn if you do, darn if you don't situations. But I would encourage anyone, and you traders who are watching this, and you're probably getting bombarded with the same sort of questions, is tell them, look, take a few minutes to learn about market timing. You don't have to be in and out like crazy. The system I'll show you in just a few seconds really hasn't made that many signals over the last 100 years when you think about it in a bigger scheme of things. But it's important to know enough about market timing to get out of the way. As I preach, as far as getting out of the way, market timing is less about beating the market and more about not letting the market beat you. And as I said a second ago, the occasional 50% haircut is key. And one thing that I'd like to research, and I kind of have the charts in my head, and I think I already know the answer, but I need to go in and look at the charts to make sure. It sure seems like the cycles have been exacerbated to where we're going to see more and more bear markets because you've got so many people in and out of the market and so much trading going on, and everything happens so quickly, as opposed to in years prior, these things would take time to unwind and work their way through the system. So nothing concrete there, but I think that the general market timing things that I'm going to discuss today and have been discussing forever will help you, even if those cycles are exacerbated, and especially if they are exacerbated. As we used to say back when I was involved with the hedge fund, he who fights and runs away lives to fight another day. As I was putting together these slides, I was thinking about something that Greg Morris's, the firm that Greg Morris worked for years ago when he was a money manager running billions of dollars. And their firm had put out a statement that said, anyone who has kept pace with the overall market should be questioned. And that statement is just as true today, or at least earlier this year before the market tanked, because if you are a firm that is timing the market and you get out when the market begins to drop about 10% or so, whatever your signals say, and the market drops 30% like it did in the pandemic and then comes right back, the buy and hold guy wins. But in the end, in the long run at least, he's not going to win. So their point was, you guys that have kept pace with the market are probably just buying and holding, and that'll work until it don't. Now, one thing I preach about a lot as far as not letting the market beat you is to focus on the downside magnitude of what can happen versus signals in and of themselves. And a death cross is usually a good example of that because market gradually rolls over. You get the death cross, the 50 goes below the 200. And not all the time, but a lot of times you'll have a big sell-off. And sometimes the market will come back. And if you look at the fact that, the market came back, you wouldn't have made any money on the short signal, and it would have just been a big old fat whipsaw, he tried to say, on if you did take the short signal. But if the market drops 30 or 40% from the signal, forget about the fact that it comes back. You need to look at what I call, or what I've stolen the term for, I should say, from Ian McActivey, the diaper change moment. And just know that once a market becomes weak, that's when bad things can begin to happen. Usually, a bear market doesn't just start off of all-time highs and then, hey, it's a bear market. And if you look at this is a weekly chart, and as I've shown before, okay, here's an all-time high here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. It was 15 weeks before you got the first sell signal, which was here. So you do have time, but as I preached, not unlimited time. And even if you didn't take that first sell signal, the next signal, which we'll discuss, took another 4 or 5 or 6 weeks before that triggered. So as I often preach, now this is looking ahead, obviously, for the next bear market, you have time, but not unlimited time. And the good thing is, and this is just TA 101, and that's why I have this little 10% line in here. This is all part of the system. A close below the 10% line and a close below the 50-week moving average, you get out of the way. And my thinking there, TA 101 again, is that if a market is going to lose half its value, it's going to lose 10% first. So here was a sell, and then afterwards, and I actually missed this signal, but there was a buy signal a few weeks after that sell signal. The reason I missed it was twofold. One, I didn't notice that the low was above the moving average, and that's what's required for your buy. You need 2 lows above the moving average, and it also has to be above the 10% line, or as what I often call the buy line. And somebody was a little upset with me that I didn't point out the sell signal the buy signal, because they took it and they wanted to know how come I'm not talking about the buy signal. I said, well, I don't think there is one. And when I looked at the charts, like, okay, I see it now. And my answer to him was, hey, even though you took it, that's fine. That's just following a system, and it's not the designer's intent. The designer's intent is to buy on strength and sell on weakness. That's my mantra, right? And in a case like this, yes, it was a signal, but the market was coming right back in. So I did ignore that signal, and actually, again, I didn't even see it in real time. But again, even if you took the signal, so what? I think it was about a 4 or 5% whipsaw. You can live with that. As Greg Morris often says, whipsaws are frustrating. Bear markets are devastating. You could survive frustration. And that's, I believe, what they were talking about in that letter was like, okay, yeah, we hadn't beat the pants off the market, but anybody who did has taken way too much risk by riding out all of these huge drawdowns, because again, that'll work until it don't. Now again, stealing a line from Ian McActivey, he talks about the diaper change moments in markets where you have these big panics and the market just drops a huge amount. And the way I use it in this system, or describe the system, is to avoid these big slides. So in this particular case, if you'd have got out on a sell signal to the low, which we saw, I think last week, you would have not lost 18% of your capital. And that diaper change moment is pretty important. When a buddy of mine was down quite a bit during the pandemic, and he happened to be visiting around that time, he was pretty depressed and he wasn't sleeping at night. And I'm not sure why he doesn't pay attention to my presentations, but that's another story altogether. Nobody calls me again when the market's doing fairly well, or even when the market is just down 10%. And that's the whole thing, the whole point I'm trying to make. So I think some market timing is better than none. And when things start to weaken, you want to get out. And whatever your signal is, whatever your weakness signal is, in this case, again, it's 10% line and the 50-week moving average, bad things can happen once the market begins to weaken. And I stole that from Baleo and Gaillard, who wrote a paper, I believe, on the 200-day moving average and talked about how bad things could happen below it. But that line of reasoning goes for any type of indicator that you're using. Just choose your favorite indicator. Now, one thing I wanted to show you here, just to give you another tool for market timing, or rehash a tool I've talked about before, is the 30 EMA on a weekly chart. Now, I always use a 30 on a daily chart, and it can be a little quicker to give you signals, obviously. But sometimes it helps to see the forest for the trees. So just to recap on Landry Light, if the price intersects the moving average, Landry Light is 0. If the low is above the moving average, it's +1. And as long as it's above the moving average each day or hour or minute, whatever time frame you're measuring, As long as it's above that moving average, you add 1 to the days of Landry light, okay? This is not magnitude, because you can notice right here, we're pretty close to the moving average. If we'd have touched it, it'd go back to 0. So pretty simple concept, but I'm pretty amazed at how well it works. And it's beginning to catch on a little bit with a lot of people. And this is something that I wrote about in 1996, believe it or not. And I've been working with it more and more in more recent times. So you can see this slide we've had, and this again is a weekly chart. We've had 2 bars of upside Landry light, and you can't hardly even see it. You really have to squint your eyes to see it down here in this little histogram. But you can see for the most part, for nearly all the year, we've had downside Landry light, that's been in red. So that's something else for you to pay attention to. And we can't bottom until we start getting some upside Landry light on the daily and the weekly and even longer term time frames. Now, of course, if you want to get real aggressive, you could look at something like an hourly bow tie. And I have one client that does just that. The only problem is with getting this aggressive is you're going to get in really early, and it's going to be great when the market does turn, but a lot of times you might be a little too early and the market rolls right back over. And the same thing happens at tops. I know he's a little aggressive at getting out when the market is at a top, but sometimes you might get a little bit of a rollover in hourly, and then it just turns out to be a bigger picture correction and the market comes right back. But anyway, I did want to show you the last hourly signal. This is a 60-minute chart, and this down here is the bow tie proper order. If the 10 is greater than the 20, and the 10 is simple and the 20 is exponential, and the 20 is greater than the 30, okay, and the 30 is also exponential, so 10 greater than 20 greater than 30, this is going to be green. If they're flipping back and forth, it's going to be yellow. The market's in a state of capitulation. And if it's red, then the market is headed lower. Now, again, this is an hourly chart, so you got to be careful not to chase your own tail, but it can help to tell you when the market might be turning. Now, the last up signal was certainly a good thing, but always look at the chart and notice that we really didn't make new highs after the signal. Went a little bit higher, but then we came right back in. So there was no follow through. This would have been a whipsaw type of signal. And you got to be careful with some of these things. You can't get too caught up. It's like, okay, it looks like we could get a turn, kind of like Aussie Man. Yeah, and nah. So I must have clicked on him once because I'm getting a ton of videos from him. But anyway, you can see we did go from red. Now we're in yellow, which means the market's in a state of capitulation, trading back and forth. And the best thing to do when it's yellow is to let them fight it out. Don't try to catch an uptrend. Don't try to catch a downtrend. Sit on your hands. Let them fight it out. So you can see we're kind of in a state of capitulation on the hourly chart. And I'll follow up on this and longer term charts also in the weekend charts. Now let's get back to your brain on trades, and let's see if we can wrap this segment up. Now, one thing I've talked about in my weekly Dave Landry's Weekend Charts show is you want to document. And if you go back several weeks, I talked about my trading journal. I showed a few pages out of that, so go back in and take a look at that. I also showed a page out of my morning pages. And while you're documenting, as I said last week, you want to write down what you're seeing that no one else is seeing. I was talking to one of the traders over the weekend at ChartCon, and he was weekend before last, I should say. And he was saying, whenever you make a trade, assume that the guy on the other end is a professional. And adding to that, he's a professional who knows a lot more than you. And why would he be willing to sell you the stock? And he's looking to get rid of the stock and you're looking to buy it. You're on two different opposite ends of the spectrum. So try to see what he's thinking. And sometimes that'll help you to see more clearly and possibly avoid a bad trade. Now, as I've said ad nauseum over the past several weeks, there's different parts of your brain that are actually working, a different psychology at work and a different neurology at work. Once you're in the trade, when you're before the trade, during the trade, and after the trade, three different things are going on in your head. And you have to work to sort of use your whole mind to sort of separate yourself from those emotions that you're going to feel in those three phases to see everything a little bit more clearly. So during a trade, make sure you document how you're feeling, your money needs, and your temptations to break the plan. As I often say, it seems like every time I walk in the house from my office, I'm hit with a new bill. And I do have this urge to go in and try to make that money, try to take that money, so to speak, out of the market. And the market doesn't care about your time frame. Right now, we're in sit on your hands mode. And as I said in my last week of charts for what I learned at ChartCon, last week at ChartCon, was in talking with one of the traders, he said, yeah, I had a really bad week a while back, and I couldn't figure out what the hell I was doing wrong. And then at the end of the week, it dawned on him he had just made a $40,000 tuition payment, and I think subconsciously he was trying to make that money back. So a lot of things I've been saying lately are, what does your action have to do with what's going on in the markets? Okay, so he was trying to make money when there was no money to be made, based on the fact that subconsciously he was trying to pay for that tuition. Now, when you're done with a trade, you need to look at the trade with 100% hindsight and then work backwards to see what foresight was really there. There is a hindsight bias, okay? And that goes for trading, goes for life and everything. But if you go in and look at the charts, and it looks a bit like an electrocardiogram, and it's not a perfect setup, and you find yourself thinking, what the hell was I thinking? That's fine. That's good. That means you're getting better at what you're doing. And then the real epiphany comes, or the real enlightenment comes, when you see the trade with 100% hindsight and say, you know what, didn't work out, but I would take that trade again tomorrow. It looked fantastic. Now, as I've been saying on and off, we're kind of doomed from the start. Curtis Faith said, the brain is not designed to process the type of low probability outcomes that traders often encounter, where losing is part of the game. And as I've said quite a bit, if you're longer term trend following, he's an ex-turtle. Like the turtles were, you're going to be wrong a lot of the time. Longer term trend following only works about 20-something% of the time. So 70% or more, you're going to be wrong of the time. And that's why I created a bit of a hybrid system to work on improving upon those numbers. We look to take the short-term profit, and then we hang around for hopefully what will turn into a longer-term gain. And it's hard to talk trading psychology without mentioning Mark Douglas. He once said, if you could put on a trade without hesitation, take it off without emotional discomfort, then you have accepted the risk. So what he's saying here kind of circles back to, are you going to be able to live with yourself? And then try to do a little time traveling, as I discussed in weeks prior, where you think about, okay, I'm going to take this trade. What are my risks? Is it really worth the risk? And again, what does the other guy know? And so on and so forth. And this statement here kind of haunts me, because this morning, for instance, put on a trade and lost. And it's like, it's kind of got me PO'd. And it's like, well, obviously, I didn't accept the risk going into the trade. Now, I talked about in weeks prior your trading journal. I also talk a lot about morning pages. As I say quite often, I wake up every morning and write 3 pages. One of the best things I think you could ever do in your life. It is hard to do. You're gonna have to force yourself to do this for about 4 to 6 weeks. But if you could make it past about 6 weeks, believe it or not, you'll actually look forward to doing these pages, and you're gonna learn a lot about yourself and a lot about your trading, and you will learn about a lot of the outside market influences. I write down, okay, am I tired? What are my ailments? What's going on? As I said in my week of charts last week, I've been having this backache in my left shoulder, which I haven't had in many, many years, when I had a dead-end job that was really I was just miserable in. Well, that has come back, and now it's making my hands numb, one hand numb at least, and it's got me thinking about, okay, my back is tensing up because I'm trying to trade this market that's just zigzagging back and forth. And so going through these morning pages every day it really makes you face the fact that you might be Einstein's definition of insanity, doing the same thing over and over and expecting a different outcome. One thing I do is I write down the number of F-bombs. If I say an F-bomb, or drop an F-bomb, I should say, I will write it down in my trading journal. And one thing that will come out of your trading journal is a lot of minor epiphanies, but these minor epiphanies can really help you longer term. And as I said quite a bit, I used to make these walk in the office trades. And that means that I walk into my office after lunch or breakfast, and all of a sudden everything looks great. I almost did that this morning. But when I walk in the office now, I write WITO, walk in the office, to make sure I don't trade for those few minutes unless I think I have the mother of all opportunities. And I later read about how judges' sentences were much more lenient after lunch than before lunch. And the reason was that the judge was a little on the hangry side. So I come back in this office feeling pretty good after just having lunch or breakfast. And the first thing I want to do is put on a bunch of trades. So a lot of these little minor epiphanies, even though they don't seem like that big of a deal, that can save you thousands of dollars. Well, once again, I get to talking about trading psychology and I run out of time, but I promise you we're going to wrap this up next week, and I'm sure we'll have more and more to say about it in weeks after that. So I want to thank everyone for watching. Again, there's links for some follow-up information, and may the trend be with you.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.